I've been dropping hints for a while now, and today I'm finally pulling back the curtain. It's not often that I add a new holding to the portfolio, but when I do, you'll be the first to know. And some of you have probably seen this coming, but we're adding none other than SCHG. I've been following this one for years, but we really dug into it here on the channel back in early 2024. And honestly, that video planted the seed. I kept watching it, I ran the numbers, and eventually I just couldn't ignore the fit. In this video, I'll walk you through why I bought it, how it fits into my portfolio strategy, and how it compares to some of our other favorite growth ETFs. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please bash the like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. A quick heads up, Seeking Alpha Premium, the platform I use for nearly all of my ETF research, is running a summer sale right now. You can try it for absolutely free for 7 days and save $60 off your first full year if you're interested. Link in the description below. You know what time it is. Let's grow. SCHG Basics. Before we get into the numbers, let's talk about how SCHG works and what it's designed to do. SCHG is the Schwab U.S. Large Cap Growth ETF. It tracks the performance of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. That index selects companies from 750 of the largest U.S. companies by market cap, and it screens them on the following: 3 to 5 year projected earnings growth, trailing 5-year revenue growth, and consistent earnings over the past 21 quarters. Basically, it screens for big companies that are growing fast and that are doing it consistently. It ends up holding about 230 stocks, and yes, the Magnificent Seven are in there. You're not missing out on the heavy hitters. And I love that it's passively managed, so there's no human gut calls. It's a rules-based system just doing its thing. And the expense ratio is an anemic 4 basis points, meaning more of the gains stay in your pocket. This is a pure growth ETF, but it's very diversified by sector, and that's what made it really start standing out to me personally. With the foundation in place, it's time to start digging into the numbers. Key metrics. Let's pull up SCHG on Seeking Alpha and run through some stats. Here's SCHG, the Schwab U.S. Large Cap Growth ETF. Oh, and you can see it's at a nice clean $28 even per share. I'm recording this close of market on the 17th of June. And let's stick to the important high-level key metrics here. I always look first at expense ratio, and you can see that SCHG has a razor-thin 4 basis points, 0.04% expense ratio, which is incredible. Pay 4 measly dollars for every 10,000 that you have invested in this bad boy. And the other important one here for a growth ETF is the assets under management. And with over $42 billion of assets under management, you know this bad boy isn't going anywhere. And now hopping on over to the holdings breakdown, you can see by sector that you're still quite high in technology at 48%. But for context, QQQ is over 50%, VGT rounds up to 100%, and most of the big growth ETFs, even the multi-sector ones, are around or above 50%. So SCHG isn't too bad on the tech. And then you add in 14% communication, 13% consumer cyclical, 9% healthcare, 7 financials, and industrials gives you about 3. So a nice balance there by sector compared to its growth peers. And then scooching down to the top 10 holdings, this is where a lot of people really like SCHG because unlike a lot of its growth ETF peers, SCHG gives you exposure to all the big boys. You have your Microsoft, Nvidia, Apple, Amazon, Meta, Broadcom, Tesla, Google, and Eli Lilly. Interesting. VGT will leave out, I think, Amazon and Meta and some other ones, but a lot of people like the diversity of SCHG, not forgetting any of the big boys, but still having 229 companies. Now, the top 10 big names are 56% of the weight, but when you distribute it relatively evenly, with Microsoft and Nvidia being a touch over 10 at the highest, and then you go down on the list here, it's a fairly balanced ETF for the growth category. Okay, and I hopped out to the charting tab. We did skip the dividends tab. Usually we look into this with even cornerstones and definitely dividend or value ETFs. But with growth ETFs, we don't really care. It has about a 0.4% yield, and that doesn't move the needle really. It does have some slight growth. But coming to the charting tab, which we absolutely care about here in the growth world, I've pulled up the following tickers. We have SCHG, of course, that's the one we're talking about today. I put QQQ and VUG next. And that's because these are multi-sector ETFs with a similar mix from a sector perspective. And I think they're the most like competition. We added VGT to get some pure tech, just to get that angle, to see how these multi-sectors have compared. And then I always like to add SPY in this case. Usually I do VU, but I want to be able to look back as far as possible just to see how they've done against the S&P 500 or the market, what most people consider the market that they're trying to beat. Oh, and for context, this QQQ, I would actually buy QQQM as a buy and hold investor, just like I'd buy VU instead of SPY. But I use these tickers because they have all the history as we zoom out. On the year to date, you can see that SCHG has actually struggled a little bit here. It's up about 0.5%, whereas QQQ is up 4.5% and VUG is up 2.5%. VGT is right in the middle at 1.3%, and then the market is right around VUG, smack dab in the middle as well. So SCHG not off to a great start, but that's only 6 months. When in doubt, zoom out. And we're looking a little better here. SCHG is up about 12% over the last year. And again, this is total return. This does include dividends reinvested. It's outperforming the Qs, which are up about 10%. Just behind VUG, which is up 12.5%. It's still out kicking tech, which is up just under 9%. And then the market itself is right there with SCHG actually at about 11.5%. Now it gets a little more fun. Let's zoom her out 3 years. Okay. You can't see me, but I'm nodding my head in appreciation saying, all right, I see you. SCHG is up 106% to its primary competition QQQ and VUG's 97 and 98% respectively. VGT comes in right between them actually, behind SCHG though, at 101%. Now that's impressive for 3 years. And they're all out kicking the market. I mean, you could argue it's a nicer 69%, but it is falling short of all these growth bros. Now, zooming out 5%, this is the one that has really impressed me lately. I've tracked these two ETFs, SCHG and QQQ, against each other for many years now. And just recently did SCHG take over the last 5-year total return, up nearly 130% to QQQ's 124. And then they're both outperforming VGT, which steps down the ladder by about the same amount at 116%. VGT is still ahead, so tech's been on a nice little run at 139%, so only up 10%. That's not that much. And then the market, it's funny, it's actually making a push here. Not that long ago, the last 5 years had growth absolutely obliterating the market. But as you know, this year's been a little interesting, but it's at a solid 106%. Now, here's one of the big dogs. 10-year total return. This is where things start to get a little more legit and proven over a variety of markets. There's nothing fluky about this. Within a category, I should say. You know, of course, it's been a growth decade, but all these growths have had the full 10 years to produce. For SCHG, 346%, falling well behind its competition QQQ at 427, but it is still slightly ahead of VUG, which is up 325. So all of these are quality, and it looks like SCHG comes in the middle on this one. VGT Tech, now it's been on a tear, let's be honest, 548%. That's fairly ridiculous. But then they're all crushing the market when we zoom it out a decade, with the market up a very solid 240, well over its 100-year average. You know, with compound math, you can't just simply divide this by 10. That's not how it works for an annualized return, but it is ahead of the 10% annualized return of the last few years. It's probably 14-ish, 15. I haven't ran it. Right in there somewhere, 13 to 15% compounded. So very solid. And now we're going to zoom out as far as we can. And the luxury we have here is the ETF in question is actually the baby of the group. So I need a minute here, but I'm going to put in specific dates. I'll be right back. All right, I'm back. And I just realized since I'm going to edit all that out, I don't know why I said I had to go away in the first place. But anyway, we have since 12/7/2009, that is the inception date, at least of the data, of SCHG. Sometimes they're off a couple days, but it's right in there. And I double checked, they all have the duration. So SCHG has returned an impressive 923%, falling well behind QQQ over that timeline, which is up 1,289%. Man, when in doubt, zoom out. This is pretty impressive. And then VUG is at a competitive but trailing 858%. VGT is barely the king over QQQ, up almost exactly 1,300%. And then they've all ran laps around the good old S&P 500, which is coming in at a still very historically impressive 621%. We are on a major bull run, so we're all blessed with these returns. Yeah, we could compare and say these two are way better than these two, but at the end of the day, we're making lots of money, and SCHG looks solid across the board. SCHG held its own against category heavyweights like VGT, QQQ, and VUG. But numbers only tell part of the story. The real question is, how does SCHG fit into your portfolio? Portfolio fit. There's no one right way to build a portfolio, but balance is always a good idea, no matter what the market's doing. And while this video is all about the best growth ETFs, I think every portfolio should consist of a mix of the following 3 types of investments. We should have our cornerstone holdings like VU and VTI or VT, broad market index ETFs. And then, of course, the quality growth ETFs that we're covering in this video. And then it never hurts to have some value/dividend ETFs like your SCHD or DGROs. And the exact mix of the 3 depends on where you're at in your investing journey. If you're on the younger side, you'll likely lean more towards growth. If you're nearing or in retirement, you'll lean more to the income side. But keeping some level of growth is still important for balance. I think SCHG is tied with QQQM for the best multi-sector growth ETF out there right now. One of these 2 is probably the right call for most investors who want broad growth exposure without going all in on tech. Now, if you've watched the channel for a while, you know that I'm a tech bull. And most of my growth allocation still lives in VGT. But even I have limits, and at some point I realized it was time to diversify the growth section a little bit. The point is that I didn't buy SCHG instead of VGT, I bought it to go alongside VGT to help balance out the portfolio. If you're younger and still working or have a high risk tolerance, SCHG would make a fine core growth holding for your portfolio. And if you're retired or getting close, maybe it's one piece of a more conservative mix. Whether it's your main growth ETF or just a complement, SCHG fits in a lot of portfolios. And I like that. But don't blindly smash the buy button just yet. Let's see how this thing stacks up in a backtest. SCHG versus the top growth ETFs. SCHG launched in late 2009, so we have 15 years of data to play with. And it just so happens that my other 3 favorite growth ETFs, VGT, VUG, and QQQ, go back even further. Let's see how SCHG stacks up against these big dogs over the last decade and a half. We're out on Portfolio Visualizer to run this backtest, and I genuinely think this is the best site on the internet to do this type of backtesting. However, it's very spendy. I just re-upped because I need it for the channel, but it's $360 per year. I've applied probably for the 20th time yesterday for the affiliate program to attempt to get a link that will help save you guys money if you want to get discounts and special deals on it. Because I know 360 is just a ton. It's worth it in my situation, but not everyone's a weirdo with a YouTube channel like me, so just know that I'm out there working for you guys. But back to business. SCHG is going to be Portfolio 1. Portfolio 2 is QQQ. QQQ, and portfolio 3 is VUG. I wanted the 3 like ETFs by each other, and then I'm able to specify a fourth, and I just threw in VGT. Now these have all smoked the market, SPY, by a lot, but I just want to show how a VGT stacks up in here since it's one that I invest in. And you can see down here, SCHG is 100% of portfolio 1, QQQ 100% of portfolio 2, and VUG 100% of portfolio 3. So we're looking at the start year, and this is based on SCHG's age, 2010 through 2025 with year-to-date ARN. So this is 15 and a half years of data. It does have through yesterday, June 16th. Our initial amount, I just put in $10,000. And I used the contribution of $500 per month. Rebalancing doesn't matter because we only have one holding for each portfolio. And then reinvest dividends, yes. And display income, yes. We're going to hit Analyze Portfolio. Okay, and we can see that we have data from the beginning of 2010 through yesterday, June 16th, 2025. So nearly 15 and a half years. And I like to start down here on the performance summary. You can see our starting balance was $10,000 with each. And at the very end, after our DCA of $500 a month for 15 and a half years, you end with a nice cool $489,000 with SCHG. Now that would have been $592,000 with QQQ, quite a bit better. You made just over 100 Gs more. But SCHG did outperform VUG, which ended at $460,000. And then VGT is the champion over here at $647,000. We're going to focus mostly on these 3, but I had to throw it in there. And we can see some of these CAGRs, but we're gonna get more into that in the return information. You have a time-weighted return, money-weighted return, and they're all pretty darn solid here, I would say. You have a best year of 50% for SCHG, 55 for QQQ, 47 for VUG. The worst years are all fairly similar. These have about the same makeups, so we won't focus too much on this. One thing I did want to look at though that is important, and its advantage of SCHG, your standard deviation, you want this lower to be less volatile. The market's 14 or 15, I want to say. I could be a little off on that right now. And things like SCHD are very low. But the standard deviation for SCHG is 16.65, much lower than 17.45. And these numbers work weird. When you're 1% higher, that's a lot. And then VUG is right there in that category. A nice little win in an underrated category for SCHG and VUG. Looking at the portfolio growth, you can see that these all trend together. When one goes up, they all go up. When the market goes down, they all go down. I just wanted to show that no matter which one of these you invest in, you're going to get the growth market by and large. They aren't going to vary that much from one another. Like you won't have one shooting up like Bitcoin or something when the others go down or vice versa. There's high correlation here. And this is further proven on the annual returns. You see from 2010 all the way through 2025 so far. We won't go through all these, but they tend to go up and down together. You can see SCHG seems to, it was the low in 2011, but it's middle of the road in 10, 12, 13. I mean, really, it's right there in the middle of most years. It was down in 15. And you can see that year QQQ went ham. And then VGT had some runs, but they're all right in there. VGT again running, same here. But the 3 core ones we're comparing, they tend to go together. Since 2020, it looks like QQQ ran away that year. The next year was SCHG's year of the 3. And then everyone was down about the same, but SCHG had a better ceiling protector in 2022 compared to the 2 peers. Is smack dab in the middle in 23. It ran away from everyone in 2024. And so far in 2025, it is in last place, but they're all right there. It's pretty early. So SCHG, you can see that low standard deviation playing through when you look at these bars. Now this is a fun one, the trailing returns. Let's focus here on the annualized return. So when we zoom out the entire 15 and a half years, you have VGT at just over 18%. And second place is actually a little higher. It's interesting. The DCA had VGT making more money, but sometimes these numbers can be a little goofy with QQQ actually number 1 here at 18.10, just ahead of VGT. But then you have SCHG slightly ahead of VUG at nearly 16% to 15.5. When we look at the last decade alone, VGT runs away a little at nearly 20%. QQQ is still pretty solid lead over its peers at 17.7, but SCHG still outperformed VUG as per usual. And the same trend in the 5-year, you actually have, besides VGT, within these three, SCHG taking the crown at 18.23%. What a crazy annualized rate, by the way. We've been really blessed the last 5 years in general. QQQ is ahead of VUG by about 1% in second place. And then over the last 3 years, this is where SCHG has really shined. It's up just over 21%, and all these other ones are coming in at just under 20%. So a 1% and change lead across the board for SCHG. That's really good. In the last year, you see a similar trend, but actually VUG is the champion at 18.4%. SCHG is comfortably second place at 17.22. And actually the big boy tech brings it up the caboose at 14.04. Again, all these percentages are very desirable when we zoom way out. But you can see here how they compare to one another. And I think the last thing we'll touch here, and this is important stuff, the expense ratio. So SCHG has a beautiful 4 basis points, and its PE ratio, its value at the time, is 33.29. And you can see that it's almost all large cap, 86%, a chunk of mid at 12.5, and then very little small cap. When we come down to QQQ, even less mid cap, virtually no small cap, and slightly bigger chunk of large cap, the expense ratio. Now QQQM would be 15 basis points, but QQQ, 20 basis points. That's a difference of 16, and that is just enough to add up over the years. And its PE ratio is actually a little more value tilted right now at 30.4, about 3 lower. Interesting there, actually. And then VUG comes smack dab in the middle of the two as far as the large cap, mid cap mix. It matches SCHG's wonderful 4 basis points expense ratio. So they both blow out QQQ here. And the PE ratio is 33.6. So more akin to SCHG. It's interesting to see QQQ have the slight value tilt right now. Even though SCHG hasn't quite kept up with VGT over the last 15 years, I still feel great adding it to my portfolio mix. It gives me broader growth exposure, tones down the volatility, and balances out the tech-heavy side of my strategy. And make no mistake, I'm still a tech bull. My VGT position is staying right where it is. This isn't about losing faith in tech. It's about smart diversification. If you're building a 3 ETF core or looking to rebalance your growth exposure, give SCHG a look. And if you already own it, drop me a comment below. I read every single one of them, and I learn a ton from you guys. And check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated, freedom is not. Thanks for watching, and I will see you in the next one. Peace.